Hi everybody, Dr. Wright here again. So in our previous Excel assignment we learned how to estimate betas and also how to calculate alphas using Jensen's alpha or the capital asset pricing model. Today I want to take us from the capital asset pricing model, which is a single index model, to what are known as multi-factor asset pricing models. The most common of which would be the four-factor model, which builds on the Fama-French three-factor model and adds to the Fama-French three-factor model an extra factor that was proposed by Carhart. So we call it the Fama-French-Carhart four-factor model, or some people just call it the Carhart four-factor model. Before I actually show you the Excel assignment, I want to take 5 to 10 minutes to just do some review of some of the basic principles behind what we're about to accomplish. Feel free to skip ahead if you don't feel like you need the review, if you just want to get straight to the Excel assignment. For those of you who feel like you might need the review, I would let the video just keep running. So when we talk about asset pricing models, we're talking about two or three really critical questions in the field of finance. One critical question in finance is, if I invest in a particular asset, how much should I expect to earn from that investment? And an asset pricing model can help us answer that question. A second important question would be, when analyzing the returns, particularly to a portfolio, and especially when we're looking at management skill or management acumen, the ability of an asset manager to actually generate returns that we should be willing to pay money for, it's very interesting and important to be able to answer this question. When I look at an asset manager's performance or the returns to a portfolio, how much of those returns are simply compensation for risk, and specifically what type of risk is driving those returns? And a related question is this asset manager generating any returns unrelated to risk? The reason that question is so important is because we know in finance that there's a general relationship that risk must be rewarded with, on average, higher compensation. So the higher the risk, the higher the average reward should be. Well, if a portfolio manager is generating high nominal or raw returns, but the bulk of those returns are coming by simply taking on high levels of risk, this should be troubling to an investor, because it means that the day will come when the risk will be realized, and instead of earning the higher return, you'll actually get your portfolio wiped out. So we're really interested to know if returns that are generated by portfolio managers are merely a compensation for risk that could one day blow up the portfolio, or if this manager has some sort of acumen and can actually generate returns separate and independent from risk. Also related to that, if a manager is simply generating returns by loading up on certain risk factors, that's something that an individual investor could recreate probably without too much trouble, depending on how the portfolio manager is doing it. So the key questions really are, how much should I expect to earn when I invest in a particular asset? The asset pricing models can answer that. And then the second question is a portfolio manager generating abnormal returns, or in other words, returns independent of risk? Or are the returns that portfolio manager is generating, are they simply a compensation for risk? And if so, which particular risk factors? So that's kind of the basis for what we're doing. Now, if we look back at CAPM, CAPM makes a set of very rigid assumptions, but the basic intuition is there's only one type of risk that is rewarded in the CAPM framework, and that is systematic risk. So when you're trying to predict the returns to a particular asset, all you're really going to have are two components. You're going to have the risk-free rate, and then you're going to have a risk premium. And the risk premium is going to be based on the level of systematic risk inherent in the asset. Specifically, beta is a measure of the amount of systematic risk that's inherent in the asset. Then the equity risk premium, which is the difference between the expected return to a well-diversified portfolio and the risk-free rate. So the equity risk premium is what we think the premium should be for bearing average systematic risk, since a well-diversified portfolio should have average systematic risk. So this represents your premium for bearing average systematic risk, and then we scale it by the amount of systematic risk inherent in the asset that we're investigating, and the product there then creates the total risk premium, which is added to the risk-free rate to get the expected return on the asset. Very simple, very intuitively pleasing, and also very easy to implement. The way that we implement it is by turning it into a single variable index model. And the way we do that is We get the time series of returns for the asset that we're investigating or the portfolio that we're investigating. And in every period, we take the return to the asset or the portfolio and we subtract out the risk-free rate. And that will be our dependent variable in the single index regression. On the right-hand side, we get the return to the market in every single period. We likewise subtract out the risk-free rate. Often people use the S&P 500 as a proxy for the market. Subtract out the risk-free rate. So in other words, every period we have the return to the asset or portfolio minus the risk-free rate, and we have the corresponding return to the market minus the risk-free rate. That right there, the return to the market minus the risk-free rate, becomes our independent variable, and we simply run a single variable or univariate regression. And in the regression, the return to the asset less the risk-free rate is the y variable. The return to the market minus the risk-free rate is the x variable. When you estimate the regression, you'll get two parameters. You'll get an intercept and a slope. So the slope then becomes the beta that is widely cited and widely reported. It's a measure of systematic risk. Remember, average systematic risk would be manifested by a beta of the value of 1. Anything above 1 represents high systematic risk. Anything less than 1 represents less systematic risk than average. The alpha, however, is where we see managerial acumen, in the sense that if we estimate this regression and we get a positive and significant alpha, that suggests that this manager is somehow generating returns that are not related to the risk-free rate and not related to systematic risk. So in other words, this alpha represents the portion of these returns that are not related to the risk-free rate or systematic risk. So in short, in a CAPM world, that would be a sign of strong managerial skill. So the beta becomes useful. It tells us how much systematic risk is inherent in the portfolio or the asset, and the alpha tells us how much the abnormal returns are. So this is what we did last Excel assignment, so that's a little bit of repeat, but I thought it might be helpful to build up then to the multi-factor models. So remember, if you have a positive and significant alpha, there are a host of reasons why you may be getting a positive and significant alpha. I'm not going to go through all of those reasons. Let me simply point out that one of the most obvious possibilities for why you might be getting a positive and significant alpha is not because this portfolio manager is generating returns that have nothing to do with risk. All you're catching here is returns that have nothing to do with systematic risk. Remember, CAPM makes the assumption that only systematic risk is rewarded, but it could be the case that other risk factors exist and are rewarded. If other risk factors independent of systematic risk exist and are rewarded, you could get a positive and significant alpha from a CAPM-based single variable index model, simply because the portfolio manager might be taking on risk that is being rewarded but is not captured in this model. So the multi-factor models are an attempt to incorporate more risk factors than simply systematic risk. The most famous of the multi-factor index models would be the Carhart and Fama-French four-factor model. So let's talk about the Fama-French-Carhart model for a second. You can see that the Fama-French-Carhart four-factor model begins exactly the same as the capital asset pricing model. The expected return for an asset or portfolio is the risk-free rate plus the equity risk premium scaled by the beta, or the amount of systematic risk. But then the model adds three additional factors. The three additional factors are right here. It's SMB, HML, and UMD. Let me explain to you what each of these are and then talk about intuition. SMB is a portfolio that is constructed by assuming a short position in large stocks based on their market capitalization, and then assuming a long position in small stocks, again, based on their market capitalization. So what you're basically doing is you're assuming a short and a long position, short in the big stocks, long in the small stocks. So whatever the small stocks are earning, you get that return. Whatever the large stocks are earning, you lose that much because you're short in those stocks. So the way that you calculate the return of this portfolio is literally to take the return to small stocks and subtract out the return to big stocks, again based on market capitalization, because you're short in the big stocks, long in the small stocks. So that's what SMB represents. It represents small minus big. Again, simply a portfolio that's long small stocks, short big stocks. HML stands for high minus low. HML is a portfolio that is constructed by assuming long positions in stocks that have a high book to market and shorting stocks that have a low book to market ratio. Again, you're assuming long positions in stocks that have high book to market ratios, and you're assuming a short position in stocks that have low book to market ratios. So by logic, similar to what we identified over here for SMB, the return to your portfolio would be the return to the high book to market stocks minus the return to low book to market stocks, because you're short in the low book to market stock. So you wouldn't get that return. You would actually have to subtract that to get your portfolio return. So it stands for high minus low. The return to high book to market stocks minus the return to low book to market stocks. Again, just for repetition, because you're long in high book to market stocks but short in low book to market stocks. UMD stands for up minus down. This is a portfolio that is constructed based on past returns. So all you do is you assume long positions in stocks that have had very good returns over the past 6 to 12 months. So those are stocks that have been up over the past 6 to 12 months. And you go short in stocks that have had poor returns over the past 6 to 12 months. Hence, they've been down. So you're long in stocks that have been up in terms of past return, and you're short in stocks that have been down in past returns. So this is momentum, otherwise known as going long winners and short losers. But for purposes of the Fama-French-Carhart model, all you're doing is assuming a long position if they've been up, short position if they've been down. So the return to your portfolio then is going to be whatever the return is to that portfolio of stocks that have had good returns over the last 6 to 12 months, the up stocks, and then you're going to subtract out whatever the return is to the stocks that have been down for the last 6 to 12 months. So again, it's up minus down. So that's what these are. It's the return to your SMB portfolio, return to your HML portfolio, and the return to your UMD portfolio. Now at this point you might be sitting there saying, why are we doing this? Why are we doing long and short portfolios based on market cap, based on market to book ratio, and based on past returns over the last 6 to 12 months? Well, the reason is this. A lot of smart people have done a lot of research, and they've discovered that if you form those portfolios, they have consistent positive returns that actually generate alphas in a CAPM framework. What I mean by that is, take the S&B portfolio and make that your dependent variable. Now run CAPM and you get a positive alpha. So for some reason, this SMB portfolio generates positive, consistent returns that result in a positive alpha. Same thing for HML and UMD. Create those portfolios, record the returns, and then put them in as the dependent variable in a CAPM regression, and you're going to get consistent, positive, and significant alphas. So this made people scratch their heads, and they finally came to this conclusion. If you can form these 3 portfolios and they consistently generate positive and significant alphas in a CAPM framework, there must be something going on. If you believe that risk requires compensation, then the fact that we have observed consistent, positive, and significant alphas for these 3 portfolios suggests there must be some risk factor driving it. If this S&B portfolio is getting huge returns, positive and significant alphas, it must represent some risk. There's got to be some risk factor driving it. So, just like the return to the market minus the risk-free rate tells you the premium that you should get for bearing average systematic risk, the return to this long-short portfolio right here, this SMB, also represents the average return that you're getting for bearing whatever risk is driving it. And we've had a harder time identifying what the risk is. But whatever the risk is, we can at least see the reward for it. So that's the reward for some risk factor that's driving this anomaly. Now you may be saying, well, why aren't you subtracting the risk-free rate? Why aren't you taking the return to the portfolio minus the risk-free rate? Well, the portfolio already does something like this. The portfolio itself is the return to small stocks minus the return to big stocks. So we've already got a difference going on down here, so we don't need to subtract out the risk-free rate. So let me just repeat that. If you form this portfolio, it results in returns that are consistently positive and significant alpha in a CAPM framework. So you get these returns that create these abnormal returns in a CAPM framework. Since we're seeing these consistent positive abnormal returns, we believe there must be a risk factor driving it. We don't know what the risk factor is specifically, but we do know that this right here represents the reward for bearing that risk. So all we then have to do is take the reward to bearing the risk and scale it by however much risk there is to this asset or portfolio. So this beta SMB is just the amount of SMB risk inherent in this asset or portfolio. Just like beta M is the amount of market or systematic risk inherent in this asset or portfolio. Well, the same logic holds for HML and UMD. This HML portfolio results in positive and significant alphas in a CAPM framework. Since this portfolio is resulting in positive and significant abnormal returns according to CAPM, there must be a risk factor driving it. We don't know the risk factor, but we can at least see the reward for bearing that risk, and all we have to do is scale it by the amount of that risk, beta HML. And the same logic holds for UMD. If the UMD portfolio results in positive and significant alphas, there must be a risk factor driving it. We don't necessarily know the risk factor, but we know the reward. So all we have to do is take the reward and multiply it by the amount of that risk factor that's inherent in the asset or the portfolio. So that's, and I'm sorry that's a bit lengthy, but I wanted to be clear about the intuition behind the Fama-French-Carhart model. And rising out of the trees and getting up to forest view, here's the vision. CAPM doesn't capture all the risk factors. The Fama-French-Carhart model is simply proposing that there are other risk factors that are rewarded. Based on empirical analysis, we see these portfolios that seem to be consistently earning these positive abnormal returns. They probably do represent risk factors, so let's throw them in the model and try to capture a few more risk factors. Well, you might be able to guess that this model, this Fama-French-Carhart four-factor model, can easily be transformed into an index model, although now it's not a single variable index model. Now it's a multi-factor index model. So we move the risk-free rate onto the left-hand side of the equation. We replace it with an alpha, and we have, again, betas matched up with all of the rewards to the various risk factors. So there's the equity risk premium, the reward for market risk. This is the return to the SMB factor. This is the return to the HML factor. This is the return to the UMD factor. If we run this regression for an asset or a portfolio, we're going to get betas for each of the risk factors. So we'll be able to see how heavily these returns are dependent on the four risk factors. And we anticipate a zero alpha. A positive and significant alpha would be a manifestation of potential asset manager acumen or skill, in the sense that that would represent returns that have nothing to do with the risk-free rate or the four risk factors in the model. So what we need to do in order to execute this multi-factor index model is get the return series for a portfolio or an asset, subtract out the risk-free rate, and then for every corresponding period get the equity risk premium, get the return to the SMB portfolio, the return to the HML portfolio, and the return to the UMD portfolio. And once we've done that, we can run the regression and see what the betas look like and see what the alpha looks like. So I would like to do this for a mutual fund. It's the T. Rowe Price Mid-Cap Growth, RPMGX is the ticker symbol. You can see that it's had quite an impressive string of returns. I'm on Morningstar, and you can see that it's clearly beaten the S&P 500, but also beaten the Mid-Cap Growth Average. 5-star fund. Looks like a very impressive mutual fund. If you look at its performance, you'll be able to see numerically the impressiveness of this mutual fund. So you can see going back several years, in 2003 it earned 38, then 18, 14, 6, 17, had a bad year in 08 but rebounded well in 09, great year in 10, struggled in 11, Year to date in 2012 looks very strong. And you can see it compares very favorably to the S&P 500. Most years beating the S&P 500 by a considerable margin. So we're going to go ahead and do our analysis on this mutual fund. And we're going to do the same thing that we did for our estimating betas assignment. We're going to start with our little macro that I've made available to the class. I'm just going to download data from December 31st of 2000 through December 31st of 2011. Remember, if you just view the macro, this is the only macro in the worksheet, so you just run the macro, and you can see that it's obtained the data for us that we need. So the first thing I'm going to do is I'm just going to save it. That should be standard operating procedure for us. So I'm just going to go save it real quick here. Excuse me while I do that. And I'll save it in the most recent version of Excel. There we go. And remember from our last assignment that we're going to ultimately need to change this date. So I'm going to go ahead and do the date manipulation right now. And remember, date is just going to be the year multiplied by 100 plus the month. That should give us what we want. And you have to format it as a general number. And if you format it as a general number, it'll give you that date format that will allow us to match it up with data that we're going to get from the Ken French library, I should say. So send that all the way down, and then I'm going to sort it like we do from oldest to newest. There we have it, and then I can hide a lot of this, hide everything I don't need. And let's go ahead and get the returns. And remember, what we're doing is RPMGX. And you know that I like to give it some formatting help just to make it look a little sharper. So we're going to do continuously compounded returns just as we've been doing for quite some time now. So it's the natural log of the ratio, right, of the current price over the previous price. Send that all the way down. Turn it into a percent with a couple decimals. Now the next thing we're going to need is the risk-free rate. If you look at it, we're going to need a risk-free rate. That's going to allow us then to get our return to RPMGX minus the risk-free rate. That'll be what we need. And then we're going to need the return to the market minus the risk-free rate. And then we're going to need SMB, HML, and UMD. If we can get all that, we can estimate the regression and make some inferences about this particular mutual fund. So let's go ahead and get the data that we need from the Ken French library. Now remember, if you just Google Ken French library, it'll pull up. There it is right there. And SMB, HML, those will be right here in the FAMA French factors. So if you just click on FAMA French factors, open that up and pull it up. Remember, that's in text format. So all you want to do is save that, save it somewhere. So here's the FAMA French factors. I'm just going to save them there. Close it out, but we also need the momentum factor, and you need to scroll down just a little bit. You can see momentum factor right here. Click on that, do the same thing. Save it. Yes, okay. So then what you need to do is you need to open those up in Excel. So go find the locations where you've saved them. And remember, one thing you might have to do down here is click on all files, not just all Excel files. Pull up the FAMA French factors and you should be able to click through it. Finish. Okay, good. Now we don't have the UMD factor, so we may as well just put UMD here and go ahead and do this. Open up the UMD factor as well. So go ahead and open up the momentum factor, and you may need to be a little more careful on this one. Yeah, see how it's not automatically separating it? No problem. Just click that you want it to be delimited by space. Click next and finish and you're fine. So notice here's the momentum factor, but it starts January 1st of 1927. So we need to just match that up. So January 1st of 1927, we can put it right there and make sure that it goes down to the end, and it does. So okay, if I were you, I would then save this as an Excel file. Because what you have here is you have the FAMA French, SMB, and HML factors, and you also have the UMD factors. So I would save this as an Excel file. There you have it. No longer need the momentum file, so I'm just going to close out of that. All right, so what we want to do over here in our file where we're going to estimate the regression, we need to get the risk-free rate. Okay, so we need to get the risk-free rate. So we're going to use the VLOOKUP function, and we're going to look up this date on this sheet over in the FAMA French factors. So we'll highlight this all the way down to the bottom, and we're going to want the fifth column, because if you look up here at the top, this is the risk-free rate, which is the fifth column. So fifth column, and I'm going to put in false, meaning we want an exact match. We need to find the exact date. We do that, and we get our risk-free rate, but remember we need to divide it by 100 because the FAMA French factors are integer format. We want them in decimal format. Send that out down the line, give it percent, a few decimal places, and now we can calculate this, the return to the mutual fund minus the risk-free rate, turn it into a percent with a couple decimals, center it. Okay. Now we need the market minus the risk-free rate, the equity risk premium. Again, we're just going to use the VLOOKUP function. Look up that date in this table right here. But this time we're going to want the second column too, and also again false. Send that, and we have to divide it by 100 and send it on down the line. Do the same thing with the SMB. So we're going to use the exact same formula. We're going to do a VLOOKUP. We're going to want that date over on this spreadsheet starting right here. And we're going to want the third column this time. So 3, again, false. And again, we have to divide by 100 and send it on down the line. HML, same thing, VLOOKUP. And I don't care if you want to copy and paste. I'm just redoing the formula so you'll see it again. We're looking up that date on this page right here. But this time we're going to want the fourth column. And divide by 100 and send it on down. And then for UMD, VLOOKUP again, this date over here. And this time we're going to want the sixth column. And lastly, divide by 100 and send it on down the line. And then we just need to format that right as percent. Give it a couple decimals, center it. Would be helpful if we centered all of this. Okay. And we can get rid of these at the very bottom since we don't need these. They're just error messages. Okay, so here's the data that we want. This represents our Y variable. There is the CAPM market risk factor right there, or I should say the equity risk premium. There's the return to the S&B portfolio. There's the return to the HML portfolio. There's the return to the UMD portfolio. Why don't we do some summary statistics real quickly? And why don't we do it this way? We'll do RPMGX minus the risk-free rate. We'll do the market minus the risk-free rate. We'll do SMB, we'll do HML, and we'll do UMD. And let's just get the mean. Let's get the annual mean. Let's get the standard deviation. Let's get the annual standard deviation and just see how it looks. So there's the average return there. There's the average return to the market. And let's get the average return to SMB and HML. And the average return to UMD. Let's annualize it. So we just take that times 12. Take it on down the line. Percent. Couple decimals. Very good. Standard deviation. STD, and remember I do it as a population. Shouldn't matter. We have a lot of observations here. Standard deviation of a population for the market risk factor. standard deviation of the S&B factor, standard deviation of the HML factor, and the standard deviation of the UMD factor. Annualize it by multiplying it by the square root of 12. And then we just want to, again, turn it into a percent with a couple of decimals. And it looks like that. And you've seen how Dr. Wright likes to format this stuff by this point. Sorry if you don't like it. Feel free to format yours however you like. Just make it look sharp and readable for your users. So let's just talk about this for a second and look at what we see here. So the return to this mutual fund minus the risk-free rate on average is 4.26%. So on average, the return to this mutual fund is 4.26% higher than the risk-free rate. That compares to a market of only 1.88%. So on average, the market, or the S&P 500, only beats the risk-free rate by 1.88% over the same sample period. So we can see that this mutual fund really is beating the S&P 500 by quite a margin, and yet the standard deviations aren't that different. So just on a raw basis, we can see that this fund really is doing well relative to the market. Now, the S&P HML, remember what this is. This is the return to small stocks minus the return to big stocks. On average, over the sample period, small stocks are outperforming big stocks by 5.17% per year. HML is the return to stocks with high book-to-market ratios minus the return to stocks with low book-to-market ratios, high minus low. On average, high book-to-market stocks, which are also known as value stocks outperform glamour or growth stocks by 4.34% per year. Remember, UMD is the returns to stocks that have done well over the past 6 to 12 months, minus the returns to stocks that have done poorly over the last 6 to 12 months. So on average, stocks that have done well over the last 6 to 12 months outperform the next month. So remember, we're ranking based on past performance, and then we're observing the next month. So on average, that next month after being ranked, the high-performing stocks outperform the poor-performing stocks by 2.67% per year. So we now just kind of looked at the raw performance, and we can see that this mutual fund looks pretty impressive relative to the S&P 500 or the market minus the risk-free rate. The question is this mutual fund really generating any returns outside of the 4 risk factors captured in the model? Remember, this risk factor right here represents systematic risk. We don't have a label for these 3 risk factors, but we believe that because these 3 strategies consistently generate abnormal returns, and you can see that they're walloping the market, because they consistently generate abnormal returns, we believe that they must represent risk in some fashion. So these would represent the reward for bearing that risk. So our question is, does this mutual fund manager generate returns outside of these risk factors, or is the mutual fund manager simply generating returns by loading up on risk? So we want to run a regression to figure that out. Now, you may be interested to see, and let me just demonstrate to you really quickly, we could do a regression, a CAPM regression, to show you that these portfolios actually generate positive abnormal returns. Let me just do it for one of them. So let me make the SMB portfolio the Y, or the dependent variable, and let's regress it on the market minus the risk-free rate. So we're just doing CAPM with the SMB portfolio, as our Y variable. When we do that, what I want you to see is this. First off, you get a very low beta. It's almost 0. And if we do an alpha in percentage terms, and that's on a monthly basis, if you do an alpha in percentage terms, you get an alpha of 0.399%. You get a very low R squared and a very low beta, but the alpha also has a low p-value, which means it's very statistically significant. In other words, that alpha is probably not 0. If the true alpha of the population were 0, you would only have a 6.9% chance of running a regression on a sample and getting that big of an alpha. So what I'm showing you is very low beta. It's got this SMB portfolio has almost no relationship to the market, and you're getting a positive and significant alpha, and you get this result repeatedly. So what does that tell you? If you're getting a repeated, consistent, positive and significant alpha, this SMB portfolio probably represents a risk factor of some kind, even though we can't peg the risk factor. So okay, we have our 4 risk factors. We have the return to our mutual fund minus the risk-free rate. Let's go ahead and run the Fama-French 4-factor, Fama-French-Carhart 4-factor regression. So here we go. Data analysis regression. And for our Y variable, we want the return to the mutual fund minus the risk-free rate. And then for the X range, we're going to highlight all 4 of these and take it on down. Before I do that, I'm going to actually insert some labels here. This will just help us. So I'm going to do this. So go to data, data analysis regression. Just tell it that now we actually have labels. This will just help us on the interpretation. Okay, so now our Y range is right here. Highlight the label and the data. And our X range, highlight the labels of all 4 variables and the data. We'll have it spit out on its own worksheet, and we'll take some time to go ahead and interpret this. And we'll highlight the variables that mean something to us here. Okay, first off, adjusted R squared, which represents the percentage of the variance in this variable that is explained by the variance in these variables. Notice that the adjusted R squared is 94%. What does that tell you? Almost all of the movement in this mutual fund's returns is explained by movement in the returns of these portfolios. So in other words, this regression is very well specified. We care about the intercept as a percentage, so let's turn it into a percent, and we'll come back to it. We also care about the p-values, and I'll turn those into percents because it makes those easier to interpret. Now the betas we don't want to turn into percents. We just want to turn them into integers with a couple of decimals. So these are really the numbers that matter to us. And we might also care about the upper and lower, but we really don't need to worry about that because we'll have everything we need over here. So first off, this portfolio or this mutual fund has a beta of 1.06, which means it almost has the exact same beta as the market itself. And you can see that that 1.06 beta has a p-value of 0, which means we may not know exactly what the beta is, but it's definitely not 0, because the way to interpret it is this way. We don't know the population beta on this risk factor, but if the population beta on this risk factor was actually 0, and then we grabbed a sample of our size and ran a regression, the chance of getting a beta that big is 0%. There's no chance that the population would have a 0 beta and we would get a beta this big by running a regression on the sample. And you can see that from the confidence interval right here. So the confidence interval for this is between 1.0 and 1.12. It's very interesting. So we're 95% confident that the beta is between 1 and 1.12. Now when I say beta, I'm meaning this beta right here, the market beta. So this is a measure of systematic risk. So it's got, systematic risk equal to the market, and it's very significant. So what does that tell you? It tells you that a lot of these returns right here are simply coming from movements in the market, though not all of it. Next, we actually have a positive beta of 0.28 on the SMB factor. So this beta right here, beta SMB, is positive 0.28, and it also has a 0 p-value. Again, how to interpret that? If the population SMB beta were 0, then the probability of pulling a sample, running a regression, and getting that big of an SMB beta is 0%. You can see that in the 95% confidence interval. We can be 95% confident that the beta is between 0.18 and 0.37. In other words, this particular mutual fund is clearly buying more small stocks than large stocks. It's generating some of its returns by leveraging on this risk factor right here. So it's getting a lot of its returns from that risk factor, and it's getting at least some of its returns from that risk factor. Lastly, we have, or not lastly, but next we have the HML factor. HML factor is minus 0.14. So this is the HML beta. It's this one right here. HML beta. The fact that the HML beta is negative, let's see if it's significant. Well, we can see that the percent is very small on the p-value. It's less than 1%. So sorry to beat a dead horse, but let's make sure we understand the interpretation. If the true population HML beta were 0, and we don't know because we don't know the population, we've taken a sample. If the population HML beta were 0, the chance of taking a sample of our size, running a regression, and getting an HML beta that small is less than 1%. In other words, we can be fairly confident that even though that might not be the beta, we can be pretty confident it's definitely less than 0 because the chance of getting a beta that extreme is almost 0. Again, you can see it in the confidence interval here, the 95% confidence interval. So the 95% confidence interval is minus 0.22 to minus 0.06. So what that tells you is instead of going long in high book-to-market stocks and short in low book-to-market stocks, this particular mutual fund is engaging in the opposite strategy. It's actually going long in low book-to-market stocks and short, well, probably not short, it's probably just avoiding high book-to-market stocks. So it's doing the opposite of the HML portfolio, or at least it's probably buying what the HML portfolio shorts, is what's going on because of that negative HML beta. Lastly, we have the UMD beta. The UMD beta is 0.03. It's very close to 0, and we can see that the p-value is 17%. So, and look at the confidence interval. The confidence interval actually straddles 0. So, in all honesty, the UMD beta, which would be this variable right here, the UMD beta right here is basically 0 for this portfolio. What does that tell you, or for this mutual fund? It tells you that this mutual fund really doesn't discriminate based on past returns. So they buy some stocks that have done well in the past, and they buy some stocks that have done poorly in the past. This factor really isn't an issue. So in essence, this mutual fund definitely follows the market. It's highly correlated with the market. A lot of the returns you see to this mutual fund are simply a function of systematic risk. It looks like it definitely leans towards small stocks as opposed to big stocks, but it leans away from high book-to-market stocks and instead buys more low book-to-market stocks. Interestingly enough, check out the intercept of 0.112% or 11.2 basis points. But if you look at the 95% confidence interval, you see the 95% confidence interval straddles 0. The p-value on the alpha is quite high. In other words, if the population alpha were 0, you have a 35% chance of getting an alpha that big just randomly. So we really don't see a positive and significant alpha. What does that tell us? Our conclusion is these really impressive raw returns are largely a function of systematic risk, buying stocks that are small as opposed to big, and they're loading up a little bit negatively on this factor, meaning instead of doing what this portfolio does, they're doing the opposite. But the sad conclusion is really there are no abnormal returns here. There are no returns being generated outside of these 4 risk factors, and quite honestly, investors could relatively easily recreate this portfolio without having to do it in a mutual fund. So that's what I wanted to show you today. I wanted to expose you to the Fama French 4-factor models. I know this is a little bit longer video than I've typically put up here, but I hope the review was helpful at the beginning, and I hope that the Excel assignment makes sense to you. As always, I'm here if you have questions, and so are the TAs. Good luck with it.